Hi everybody, it's Mark here at Teslary. Tesla closed red, $251.12, or about $7.75 lower than yesterday's close. In percentage terms, just shy of 3% lower. And the market didn't do so well either, so Tesla kind of moved down with the rest of it. The reason for that? Well, there's a couple of reasons. Let's talk about the first one before we get to the price action. Let's look at the Barron's report about consumer sentiment. Consumer sentiment came in really lower, with the preliminary reading of 63 being much lower than what people assumed it would be, around 67.5. Bill Adams in this report from Barron says consumers are likely worried that his Israel-Hamas war pushes up gas prices. Though to be fair, that's only 1 week of surveying. But if they did all the surveying in last week, sure, that could have pushed gas prices up. But the reality is gas has been up for a very long time. And you know what? So has been food. So it's always interesting. We always look at core inflation readings, with core inflation excluding the quote volatile food and gas portions of the report. But as you and I know, if you have friends who drive ICE cars, if you just go to the grocery store, try to buy food, everything's still very expensive. Remember, inflation is the rate of change. 1% inflation still means things are going up in price. Deflation would mean that things are coming down in price. Now, to be fair, out of all the things that are going up in the world, the only thing coming down in price are Teslas. So when Elon can realize lower costs of goods, he can pass it on to consumers. But apparently, no one else wants to do that. Though we do know gas goes down if oil goes down. But is oil going to go down with the Middle East kind of sparking a conflict? The Middle East, it's going to be a tough situation, because based off the price action, you can see how it is really affecting the overall sentiment of stocks. So yes, we had consumer sentiment come in, and you can see that when we go back to the charts. We'll look at 10 o'clock in the morning when this came out. So let's find 10 o'clock. Let's go into a smaller time frame as well. So here is it on the 5-minute. Here's 10 o'clock, and it sold off exactly from that moment, and it sold off considerably for Tesla and the rest of the market as well. But if you look at the red line, this is something we drew yesterday. I did not draw the red line today. We were assuming, and it's hard for me to draw Tesla trading flat. I don't really know how to do that. I do know that you can kind of predict where price wants to go if things are going in a direction. So if things were going to go up, this is how I saw it going up. And if things were to go down, this is how I foresaw it would go down. And guess what? It did exactly that. It found support exactly where? $250 a share. Does that? Obviously, it's a nice round number. And the market didn't want to pay it out. And that's the only reason stocks didn't fall further, in my opinion. I think if it wasn't for the fact that it was a large expiry day, it's not OPEX, but it's Friday with a lot of single tickers expiring options. So for example, if it was Wednesday and the same stuff came out, if consumer sentiment came out on a Wednesday, if there was a war sparking in the Middle East on Wednesday, I think you would have seen stocks not find a base. I think it would have just freely sold, be a little bit more organic and sell. But luckily for us, I guess, today had a lot of options expiring. And to be fair, a lot of options are expiring in the money. A lot of puts were bought early in the morning, and pricing got below it and never got back above it. So there was a lot of puts, 255, 260, that got paid out in full. And with very little action that would reduce their value, really. It was just like straight down. But we anticipated that. Right? So if you were kind of plotting the same idea on your chart, this is what makes sense. What does that mean? Does it mean on Monday we're going to get a little blip? I have no idea. We're going to have a long weekend, and to understand the idea that there's a lot of uncertainty going into a long weekend. 1 week after a war kicked off in between Hamas and Israel. Look at the VIX. Let's take a look at the VIX. The VIX is up huge, 15.6%. I think at the peak it was like well over 20%. But the market's only down, 0.5%? What is it down? Actually, I don't remember. Yeah, 0.5%. So the S&P 500 is down 0.5%. The VIX went up at one point in time 20%. There's kind of competing ideas here. Is that, okay, the VIX is up. You think, well, the volatility is up. But the reality is a lot of people have what? There's a lot of interest to hedge positions right now. Especially with uncertainty. You might find that if you talk to some type of momentum trader or some kind of big money trader, they might tell you maybe the margin requirements are going up, right? Maybe they don't have as much margin, or they're so margined out that they want to be hedged. So they're willing to pay a premium to be hedged. And that's what VIX is kind of representing. A lot of hedging is going into this weekend because you just don't know what's going to happen with the Middle East. There are points in time, and let's go to the S&P 500 chart real quick. Let's go to a smaller time frame where there were just sharp sells. Actually, we'll go to the minute. There were just sharp sells during the course of the day. And a lot of these sells in the late afternoon the middle of the afternoon, these were like, okay, so, there's a rocket coming over from southern Lebanon fired by Hezbollah to the northern forces in Israel. Or Israel shoots an artillery shell into a reporter's van. Or there's another point in time, I think it was like late morning, where it was, Israel has gotten the blessing of the United States to do whatever they want and invade Gaza. And we know Israel is building up forces around Gaza right now. There's already been some incursions into Gaza by Israelis. So there's a lot of stuff going on. And the West Bank situation and northern parts of Israel that are bordering next to Lebanon, that's providing this kind of geopolitical uncertainty that traders just don't know what to do with, right? They thought, like, if you look at it, let's go back on a bigger time frame. They thought this was the bottom, nice easy base. They went super long, and because a lot of people weren't long around this point in time, CTAs were they're not positioned at all, though asset managers were. I talked about that yesterday. But if you're really heavily long, you're going into a weekend where you just when anything can happen, the VIX represents that mostly. Now, the stocks didn't fall much as well for another reason. It's because the yields came down a lot. So there's this flight into safety. There's a flight into safety for yields where people thought yields would be going up to make a new high just yesterday. And now you see just a straight sell. Now, if you look, this is something we've been watching on the long bond, 4.8%. You see it fall through really nicely through 4.8%. It gets bought back up to 4.8%. It tests the bottom side and then sells off. That's what you kind of want to see for yields. But from a longer term point, from a short perspective, I don't know if this holds. And let's look at gold. Gold, another flight to safety. You're seeing a large move on gold. You're seeing multiple percentage points on gold. And if you look at the chart going back, and this is an hourly chart, you don't really see strong moves like that. Right here, this was in March. And here, now we have it in October of this year. This is like a 3.5%? 3.4% move on gold. So we have money being moved to gold, which is what? A preservation of capital. Just, it doesn't have a yield, but it keeps you from losing too much money, right? Usually that's something that's called like an inflation hedge. And the people were really crapping on gold last year, but gold did perform better than the index did. So it did its job, right? It preserved capital. It's not meant to make you rich. It's just meant so you don't lose as much money if you're in equities. Now we have yields coming down, have gold going up. That makes sense. But those trades, I think they're just different versions of hedging. And I think you'll see it in different ways too. It's like, okay, so I'm going to get into gold, but maybe this is just driven purely by the fact that the gold ETF has a lot of calls against it, and it's driving up the price of the underlying. It's driving up the price of the commodity. The gold ETF is a huge ETF, and it can move the commodity like that sometimes. And it's really just people hedging their positions in all these kind of intricate ways. You see that people going long in TLT, people going long on bonds. And then you have what? You have energy doing really, really well. Energy is doing great. Energy had a pretty solid day today, actually, being up 2.2%. These are just kind of different ways to get yourself in position to take advantage of the uncertainty, but also at the same time, if you're very much exposed to equity, this is your hedge. You have, if oil goes up because Iran gets into a war, guess what? You're covered because you're long oil and you're long equity. Maybe it balances out. If there's going to be some type of a third party entering the war, you're in gold, and maybe gold comes down a little bit, but it won't drop perhaps what stocks could do. Maybe stocks could drop 4 or 5% if another combatant enters the war against Israel. So that's kind of what we're seeing. You can see a VIX go up 20%, and you can see stocks go down like 0.2% early in the morning. Like, that's like, what's going on? It doesn't make sense. But if you look at it, it's really more people are just trying to survive the weekend, right? They're trying to survive the weekend. What's our job though as Tesla shareholders? Our job is trying to survive earnings next week. So we got earnings coming out on Wednesday. And what are we going to do with that? We know what? We know that most of the time, the majority of the time, Tesla stock acts very badly. reacts very badly. And this might be one of these reports that is going to be a real gray area as far as how to perceive it right off the bat. Like, what do you want to see? Like, we have lower deliveries. We have like really inefficient factories right now. We can all, be happy about, the Model 3 Plus is ramping up really nicely. But even if we're making 4,000 Model 3s a week in Giga Shanghai, which we are, that's not the same number as it was before the Model 3 Plus was announced. Okay, so we know that we're not producing as many Model Ys there because they were also changed. We know we're not producing as many Model 3s still. We know that the Model Y assembly line was shut down in Giga Texas for 3 weeks. We know that Cybertruck is not ramping in any particular way right now. What does that do to an earnings report that had lower deliveries? We know that we spent what? We're building out factories. We're building out Giga Texas. We're building out Giga Nevada. We're building the refinery. We got battery Megapack factory starting up in Shanghai. We got the Giga Mexico starting up. We got the battery factory in Giga Texas almost complete. So there's so many things that are going on, and those all cost money. And just not to mention developing those assembly lines for the new cars, developing the new cars, all that costs money, and you're not getting enough volume out of those new things to even pay back all the investments you're making in to the company, along with the billions of dollars in compute for Dojo, for the robot. You're talking about a lot of costs tied with a lot of inefficiencies. What do you do with that information? That's the question. How much of it is priced in now? But we know that from the deliveries aspect, a lot of analysts from last week were not prepared really well to know that the deliveries they're down because they weren't following the company close enough, which is weird. They're analysts. But anyways, they weren't. So we got to prepare ourselves kind of mentally for that idea. Something that I do understand is that one of the things about earnings week is the expansion volatility. Now you can see from my chart that we have a much bigger estimated move, right? So usually when we calculate a move for like regular weeks, it's like 4.5%. And I really like to tie it towards a strike price. So 270 or like 250 from this week, right? And it actually worked out very well. It traded well within that range, and that makes sense because there wasn't as much Tesla specific news that would affect the pricing. Now, I would say that, around this, for this week's calculation, I did try to tie it to strike prices, 227.50 and then 275 on the top side. But you're just me saying those numbers, we're talking about a huge range. We're talking like $50. And the reason for that is because there are moves, and you can see it from last July, where, within a couple of days after the earnings report came out, we're talking about a move that's something like 13%. And this move that I'm calculating for us for this coming week is about 9.5%. So if I was to kind of measure from here, that's 9.5 up and then 9.47 down. So that's kind of what the possibility is. Now I understand that the price action intra-week could really affect it. Like, meaning if we go up on Monday, let's say we go to like 258 on Monday, and then you sell off from there, you can still sell off 13% from that point, and that'll be out an outside week from our calculated EM. But that's something we'll talk about next week if that comes to pass. But for now, just know that there's a very large volatility. But how does that work in your favor? It can work in your favor because you can sell premium for much higher than you typically could. I mean, we'll talk about the premium for calls after, like the 2 weeks from now, like the week thereafter, and you understand like I could have sold this call for like double the amount that I could sell after earnings. And that's really one of the only effective ways to hedge, is to kind of sell premium, because if you're trying to buy puts, if it doesn't move enough, your puts will go worthless the day after earnings. I mean, just immediately. You can also do inverse shares, TSLQ, meaning like, let's say it's Wednesday. It's Wednesday afternoon, 10 minutes before the close, and Tesla's up 2%. Well, you can buy a couple of shares of TSLQ depending on whatever ratio you want to hedge yourself with, and that could be your hedge that you can get rid of after hours. So it's even almost better if you have margin. It's almost better sometimes than getting a put, because you can actually just get out of it if you need to, right? It's after hours, you can sell it. You can't do that with options, but you can do it with inverse shares, and something a lot of people do with SQQ, which is a triple inverse of the Nasdaq. So something to think about. We can talk about it again next week. But this is what I'm kind of thinking about when it comes to the possible range. It could be very, very violent, and compounded with that is the war in the Middle East. And we still, of course, have Ukraine and Russia. Who knows what's going to happen there, considering that most eyes are now focused on the Middle East instead of Southeastern Europe. Something to think about. There's a lot going on in the world, and even just from a geopolitical kind of thing, but also from a financial thing, America is not in great shape when it comes to our debt. People are looking at our debt with no desire to own it at all, and we have to pay an enormous amount for people to hold our debt. I mean, it's just not a good combination when it comes to the fiscal kind of responsibility that the government has, which is it completely lacks it. It doesn't have any at all. And that kind of makes our debt kind of that undesirable, and this increases yields, which of course makes financial conditions much tighter than they really need to be. But the trade-off is we don't have any Fed fund futures hikes planned for the rest of the cycle. From it looks like yesterday there were some bets that November and December would have a hike, but now they're kind of those things kind of reverse it. It looks like you might get some cuts going into next June, perhaps at the earliest. So that's what the bet is so far for next June, for our first cut. So otherwise than that, we just have to kind of survive the weekend, get through this weekend, reevaluate on Monday, because we can't do anything anyways, and we hope that the moves aren't too violent during this weekend. That if we're not hedged enough, I really want anyone to get caught off sides. That would be really unfortunate. But the reality is just the uncertainty is large, and that's reflected in the VIX. So thanks so much for listening, guys, and I'll have some other videos out for you guys this weekend. Take care. Bye.